A huge part of getting good financing is being able to communicate your deal with a lender. The truth is, lenders do not like confusion, and the ones that do are going to charge you an arm and a leg for that. But why should your deal have to pay that price? Especially if we're able to structure it so that it's more digestible to lenders, and then you could end up walking away with amazing terms. You just have to learn how to speak the language of the lenders. And that's what we're going to break down in today's video. So let's get started. When you go to a lender, you're not just giving them a project, it's an entire package. And the quality of that package says a lot about your professionalism and your credibility. So we want to ensure that this package is robust and that it represents your company well. So here are some things I want you to include in this package. Your Proforma tells the numerical story of your project. First up, we have the income that we're expecting to generate from this project. We have expenses, then we have cash flow, we have project returns, and stabilization timeline, as well as exit or refinance assumptions. And when we're looking at these assumptions, we want to ensure that they are realistic, because at the end of the day, the job of the lender is to protect against downside. They're trying to mitigate risk. So you don't want to present them with numbers that are unrealistic. It invites them to discredit everything else that you've put forward. So you want to ensure that these numbers are realistic and that this is something that you're able to achieve with your project. Next up, we have sources and uses. This document details where the money is coming from and what it is being spent on. So for the sources side, that's letting us know how much of the money is equity and how much is debt. Or if we have anything in between like mezz or pref equity, it's telling us about the capital stack and the sources of our funds. Secondly, uses. This is just the project budget, like what are we spending the money on? So this is where we have three major categories. We have land costs, then we have hard costs, and we have soft costs. I think a lot of developers underestimate how much soft costs can really take up. Like it could be a substantial amount of your project, especially if you have any delays, because then you're also incurring interest the longer this debt is outstanding, right? So I find that a lot of developers would just focus primarily on hard costs, like this is all, no babes, there's more. So I think we should definitely consider the soft cost part of it so that we can have a comprehensive uses, and we'll combine both of those and we get our sources and our uses. Another really important document to have is your draw schedule, especially if you're doing construction or heavy value add. Lenders want to see how much you're spending and when you're spending it, and they want to see your timeline to ensure that it's realistic. They also use this draw schedule to size the loan in terms of the interest reserve portion of it, because they want to be able to manage their own exposure as well. But this is also helpful for you so that you can see how much interest you're incurring along the timeline of the project. Because what many lenders will do is that they will size the loan and include this interest reserve in the loan amount. So every month you're not paying out of pocket, and that can be a benefit, right? But at the same time, you're also paying interest on a higher loan amount, and it depends on when you're drawing this. So if you're able to underwrite that to project what these draws will look like, you'll be able to come up with a more comprehensive sources and uses and budget so that you could really see the true cost of the project. So really good developers do a good job of mapping these costs out and seeing what those numbers look like. The number one concern for lenders is getting their money back. So they want to ensure that whatever it is that you're building will be able to be absorbed into the market, meaning you could either rent it or sell it at the prices that you are projecting. Because at the end of the day, they don't want the project to be stalled, because once you've built this, oh, you're not getting the rents that you originally projected, or you're not getting the sale price that you wanted. Now this is incurring more risk because you're like, oh my goodness, these numbers do not make sense. But you want to be prudent and you want to show them that, look, I've done my market research, I've taken a stock of the competition, and this is what is happening right now. And my rents are, you're able to defend your rents, you're able to defend your sales price. So being able to give them this information, because the thing with lenders, if you allow them to fill in the gap they will fill it in with the worst case scenario, and you don't want that for your project. So being able to look at the market, and for instance, if you are a multifamily developer, you're looking at other apartment complexes, you're looking at the unit types, you're looking at the square footage, you're looking at the amenities that they're offering, you're looking at if they're offering any concessions, any free rent, and you're baking that into this comps, like this set of comps that you're producing for these lenders. And another tip here is to ensure that, or if possible, that you have more than one exit strategy. Because let's say your original intention was to sell it, but the market has changed and it's not you're not able to get the sales price that you would have wanted originally. But it could also work if you're able to rent it. So if you're able to show these different exit strategies to show that you have thought or given good thought towards what this could look like, it bodes better for you because you're looking at what the upside could be and what the downside could be. And lenders, they're looking at the downside. So if you could meet them there, then that would bode better for your deal. So now we're going to zoom out a bit from the project and start looking more closely at you, the developer, the sponsor of the project. And this is where a developer bio comes in handy. It's how we're going to showcase your experience to the lender. It's going to show them that you have a track record of excellence and that you're able to execute on these sorts of projects. Because at the end of the day, lenders are not in the business of real estate development. Like, they're not trying to build stuff. They're in the business of lending. So if you are not able to finish this project and you give them a half-baked mid-construction project, they don't know what to do with that. They have to go and try to find a buyer, somebody who is interested, and maybe they get cents on the dollar, and it's a whole headache for them. So they want to avoid that, okay? So how they do that? They spot people who have the capability and the experience of finishing these sorts of projects so that they can get back their money and put it into the next project. And this is what we're able to show them with a developer bio. And you don't have to be a massive developer, but you just want to show them that you have the experience and the competence to finish this project. Lenders want to see your personal financial statement, your PFS. In the case of default, they want to know that they could come to you and look in your personal accounts and get their money to be made whole. And on this document, on this PFS, you're showing them your liquidity, your assets, your liabilities, and ultimately what your net worth is. Once they have that, they could get more comfortable, because at the end of the day, what lenders want? They want their money back. And in the case of recourse, where you're saying, I am standing so much behind this project that I am willing to put my personal assets on the line. And when lenders are able to see that, oh, this is a recourse, all right, I could budge a little bit more. Maybe I could go up on the loan amount. Maybe I could, take down the points a bit, because you're willing to put this amount of skin in the game in the case of default. So that is what the PFS will show them. It's like, in the case of default, in the case that this goes awry, that this person can give me my money back. Now that we've gone through what lenders want to see in a project, let's break down how they're evaluating your deals behind the scenes. The first metric that lenders are looking at is loan to value or loan to cost, because they're asking themselves, how much skin does this operator have in the game? And am I lending too much relative to the risk? So when it comes down to your project, they probably want to see at least 5 to 10% of the capital stack being equity. Because at the end of the day, if you don't believe in your project and you aren't able to put your personal money up to fund this project, like, why should I believe as a lender? The more you're able to put up and to put your skin in the game, it makes me look at that project more positively, more optimistically, because you are able to say, I'm throwing my hat in the game because this is a good deal and I'm willing to put my money behind it. Kind of like putting your money where your mouth is, right? And there's one quote that comes to mind from Bob Hope. It says, a bank is a place that will lend you money if you prove to them that you don't need it. And it's so true. Like, if you're able to say, no, I have 20%, I have 25%, only need 75%, that, like, lenders look at that more. They like that better, especially if they're not really into riskier deals. Like, you're lowering their exposure to that deal. Not to say that other lenders won't go up on the LTV, but just generally speaking, the more money you have in your own deal, the better, and you could negotiate better terms because you're putting up so much capital for yourself. Next up, we have debt service coverage ratio. This measures how well your project is able to support or sustain the loan based on the income that it generates. If your project does not meet their threshold, it's not getting approved. Like, just realize that. A lot of lenders love to flaunt, oh yes, we go up to 75, we go up to 90%, 85%. Babes, if they're not seeing that 1.2, that 1.25, that 1.18, 1.15 is the lowest I've seen so far. If they're not seeing that, they'll quickly double take and be like, okay, we need to lower the loan amount. Like, just for example's sake, let's say your project generates $100 every month. And to service this loan, to support this loan, you have to pay the lender $80. Okay, that's fine. That's 1.2, it's over the threshold. But let's say that monthly service amount goes up to 90. No, you can't support it, and they're not willing, even though technically you'll have $10 left, that's not enough for them to feel comfortable. They want to ensure that the project itself can generate enough money to be able to pay down the loan every month. It could be interest only, or it could be principal and interest. So this is a very important metric to pay attention to, because this is where they check the box on yes, or whether they check the box on no. So LTV is the first step. DSCR, this is the decision maker. Next up, we have exit strategy. This is when the lender is asking, how is this loan going to get paid off? Like, who is going to buy this thing? What does takeout financing look like? They want to ensure that the next lender is able to value this asset in a way that is above whatever their loan amount is, so that it's a seamless transition. So for instance, in the case of construction, they were with you when you had dirt, now you have your vertical building. The valuation for this asset needs to be above what they paid, so that you don't have to come out of pocket, and that when it's time to transition, that they could get their money to roll it into something else. And as I said previously, it pays to have more than one exit strategy, right? You don't just want to be banking on this getting sold. Like, what if you have to lease it? Like, what do those numbers look like? And you want to underwrite that accordingly and show that to the lenders, because trust me, they're going to look at that. Your financial position as a sponsor truly matters, because lenders want to see that you're able to survive certain surprises. As much as we want things to go as planned, that's not always the case in construction. We have delays, change orders, overruns, and certain costs start to creep up even with the built-in contingencies. Look at COVID. Nobody could predict that. You know, we have things that come up and we have to deal with them accordingly. And with a strong financial position, that just indicates more capability and agility and trust when it comes on to these lenders. When you combine the right documentation with a clear understanding of how lenders think and underwrite, you stop submitting deals that feel hopeful and start submitting ones that are bankable and get way better terms.